stop what you're doing right now, because what you are about to hear could save you thousands of dollars. And for some of you watching, it could save your entire retirement. We are talking about 5 specific things that the IRS has the legal authority to take from you after the age of 60. And the most frightening part is that the majority of retirees have absolutely no idea these rules even exist. In the next few minutes, I'm going to walk you through every single one of them, what they are, why they apply to you, and most importantly, what you need to do right now to protect yourself. And before we get to number 3, I want you to pay very close attention, because that one is the one that catches the most seniors completely off guard. We have seen people lose tens of thousands of dollars because of it, and it can happen to anyone, even people who have been doing everything right their whole lives. You have paid your taxes. You followed the rules. You worked hard for 30 or 40 years, saved your money, built your retirement nest egg, and now you just want to enjoy the life you earned. And most financial advisors and accountants do not explain clearly enough. The IRS does not care how hard you worked. They have rules, and those rules do not pause just because you retired. In fact, retirement can actually trigger new tax obligations that you never had to worry about while you were working. And the moment you miss a deadline, misunderstand a rule, or make one of these very common mistakes, the IRS can legally come for your money. The first thing the IRS can take from you after 60 is your retirement account distributions, specifically because of something called required minimum distributions, or RMDs. Now, you may have heard this term before, but here's what most people do not fully understand about it. When you have money sitting in a traditional IRA, a 401k, a 403b, or most other tax-deferred retirement accounts, the government has been waiting patiently for their cut. You got a tax break when you put that money in. You got a tax break while it grew. But the IRS does not let that go on forever. Once you reach a certain age, you are legally required to start taking money out of those accounts every single year, whether you need the money or not. And if you fail to take out the correct amount on time, the IRS can penalize you 25% of the amount you should have withdrawn. That is not a typo. 25%. On top of the income taxes you already owe on the withdrawal. For a retiree living on a fixed income, that kind of penalty can be devastating. Now here's an important update you need to know. The Secure 2.0 Act changed the RMD starting age. If you were born in 1951 or later, your RMDs now start at age 73. And if you were born in 1960 or later, your starting age will be 75. This is a significant change, and many retirees are still operating under the old rules. The second thing the IRS can take from you is a percentage of your Social Security benefits. Now, this one shocks people every single time, because most retirees grew up believing that Social Security was their money, that they earned it, they paid into it their whole lives, and they would get to keep all of it in retirement. And while that is emotionally true, the tax code tells a different story. Depending on your total income in retirement, up to 85% of your Social Security benefits can become taxable. Here's how it works. The IRS uses something called your combined income, which is your adjusted gross income, plus any non-taxable interest you earn, plus half of your Social Security benefits. If that number exceeds $25,000 for a single filer or $32,000 for a married couple filing jointly, you'll owe taxes on a portion of your Social Security. And the more income you have, the larger the portion that gets taxed, up to that 85% ceiling. So if you're also pulling from a pension, taking retirement account distributions, or earning rental income, there's a very real chance that a significant chunk of your Social Security check is going right back to the government. The practical step here is to sit down and calculate your combined income right now. Many retirees discover this problem for the first time when their tax bill arrives in the spring, and by then, it is too late to do much about it for that year. Now, before we get to number 3, and again, this is the one I really need you to stay for, I want to take just a moment to ask you a favor. If this information is valuable to you, if you feel like it is something your friends, your spouse, your adult children should know about, please take 2 seconds right now and hit the like button on this video. And if you are not already subscribed to this channel, please subscribe and turn on the notification bell. We put out updates about Social Security, Medicare, IRS rules, and retirement benefits every single week. This community is growing fast because people are hungry for this kind of clear, honest, practical information. and we never want you to miss an update that could directly affect your financial security. Now, let us get to number 3, because this one is genuinely alarming. The third thing the IRS can take from you after 60, and the one that catches the most people completely off guard, is a portion of your inherited IRA or inherited retirement account. Here's the situation. Maybe a parent passed away or a spouse, and they left you a retirement account. You think of it as a gift, a final act of love and generosity. But the IRS sees it very differently. Under the rules established by the Secure Act and then modified again by the Secure 2.0 Act, most non-spouse beneficiaries who inherit a retirement account are now required to fully drain that account and pay income taxes on every dollar within 10 years of the original owner's death. The IRS later clarified, after years of confusion, that in many situations you cannot just wait until year 10 and take it all out at once. If the original account owner had already started taking their own RMDs, you may be required to take annual distributions throughout that 10-year window. Missing these annual distributions means a penalty. Draining the account all at once in a high-income year means a potentially enormous tax bill that could push you into a much higher tax bracket. Many retirees who inherit an IRA from a parent have no idea this 10-year rule exists. They leave the money alone, thinking they are being responsible and conservative, and then they discover they owe years of back taxes and penalties. The practical step here is to contact a tax professional or financial advisor the moment you inherit any retirement account, before you touch a single dollar, so you can build a distribution strategy that minimizes your tax exposure. The fourth thing the IRS can take from you is tied to something most people never think twice about: the sale of your home. Now, you may have heard that there is a tax exclusion available when you sell your primary residence. And that is true. Up to $250,000 of profit is excluded from capital gains tax for single filers, and up to $500,000 for married couples. If you have lived in your home for 30 or 40 years, there's a very good chance that its value has grown dramatically, far beyond those exclusion limits. Any profit above the exclusion amount is subject to capital gains tax, and depending on your total income for the year, that rate could be 15 or even 20%. And because many retirees sell their family home as part of their retirement plan, downsizing, moving closer to grandchildren, or relocating to a warmer state, this tax can come as a brutal and unexpected shock. Let us use a realistic example. Say you bought your home in 1985 for $80,000, and you sell it today for $680,000. Your profit is $600,000. As a married couple, $500,000 of that is excluded, but the remaining $100,000 is fully taxable. At a 15% capital gains rate, you are writing a check to the IRS for $15,000. Some people in high-income years could owe even more. The key step here is to plan ahead before you list your house. Speak with a tax professional to understand exactly what your capital gains exposure is and what strategies might be available to reduce it. The fifth thing the IRS can take from you, and this one is growing more common every year, involves penalty taxes and withholding errors related to pension income, annuity payments, and part-time or gig work income in retirement. Many retirees assume that because they are retired, they no longer have to worry about estimated taxes or withholding. That assumption is wrong, and it costs people every single year. When you receive pension payments, annuity income, or money from freelance or consulting work, you are required to either have taxes withheld from those payments or to pay estimated taxes to the IRS 4 times a year. If you do not, and you owe more than $1,000 in taxes at the end of the year, the IRS can charge you an underpayment penalty on top of everything else you owe. This is especially dangerous for retirees who are doing a little bit of consulting work on the side, selling crafts or goods online, driving for a rideshare service, or doing any kind of freelance work. Any income you earn that does not automatically have taxes withheld creates a potential underpayment situation. The fix is simple but requires you to be proactive. Estimate your total income for the year, calculate your approximate tax liability, and either adjust your withholding on existing income sources or make quarterly estimated tax payments. The IRS deadlines for estimated taxes fall in April, June, September, and January, and missing them even by a few days can trigger penalties. The tax code is complex. It changes every few years. The rules that applied when you were working are often completely different from the rules that apply in retirement. And the financial advice you may have gotten 20 years ago might not reflect current law at all. That is why staying informed is not just a good idea. It is genuinely a form of financial self-defense. We have spoken with retirees who lost thousands of dollars not because they did anything wrong, but simply because no one ever sat down and explained the rules clearly. They did not know about the RMD deadline. They did not know Social Security could be taxed. They had no idea about the 10-year inherited IRA rule. And by the time they found out, the damage was already done. So here's what we want you to do after watching this video. First, find out your RMD starting age and whether you're currently required to take distributions. If you're already past that age and have not been taking them, speak with a tax professional immediately. There is a correction process available, and the penalty can sometimes be waived, but you have to act quickly. Second, calculate your combined income to determine how much of your Social Security may be taxable this year, and plan accordingly. Third, if you have inherited or expect to inherit a retirement account, do not wait. Get professional guidance right away before the clock on that 10-year window starts working against you. Fourth, if you are planning to sell your home, get a clear picture of your capital gains exposure before you sign any contracts. And fifth, review every source of income you have in retirement and make sure taxes are being properly withheld or that you are making estimated tax payments on time. The IRS has enormous legal authority, and that authority does not decrease just because you have retired. If anything, retirement creates new tax complexity that requires more attention than your working years. But the good news, and there really is good news here, is that none of these situations is hopeless. Every single one of them can be managed, minimized, or planned around if you know what you're dealing with ahead of time. Knowledge is the difference between a retirement that feels secure and a retirement that is constantly under threat. And that is exactly why this channel exists. We believe that every senior and every retiree deserves clear, honest, up-to-date information about the rules that govern their financial life, without jargon, without confusing fine print, and without anyone trying to sell them something. If you found this video valuable, please do not keep it to yourself. Share it with a spouse, a sibling, a friend, or an adult child who helps manage the finances in your family. You could be saving someone you love from a very painful and expensive mistake. And if you have not already subscribed to this channel, please do it right now. Hit that subscribe button, turn on the notification bell, and join the hundreds of thousands of people who rely on this channel to stay ahead of the changes that matter most to their retirement, their benefits, and their financial future. Because the next update could be the most important one yet, and you do not want to miss it.